All right, today we're going to talk about a number you see everywhere in finance. But what if I told you it's not really a number at all? It's a story. It's a psychological profile of the entire market. Yeah, let's get into it.
No, really, just think about that. When you see a stock trading at, I don't know, 20 times earnings, what are you really seeing? Is it just a cold, hard fact, or is it something else? Something, well, more human?
Because that's the whole idea here. That simple little ratio, the PE multiple, it's not just math. Think of it like a container. And crammed inside, you've got the collective hopes of millions of investors, all their fears, all the crazy biases that make us, well, us. It's a story about tomorrow being told today.
All right, so let's start cracking that code, shall we? We've got to look beyond that simple ratio and see the machinery that's humming away underneath.
So, on the surface, a valuation multiple is just a shortcut, right? You take the company's price, you divide it by something like its earnings, bam, you get the PE ratio. It's a beautifully simple way to compare different companies, kind of like comparing price tags. But, and this is a big but, that simplicity is incredibly deceiving.
Okay, so here's where we pull back the first curtain. Because these simple multiples, they're actually hiding a much more complex financial engine.
And that engine is what we call a discounted cash flow, or DCF. Now, a DCF, that's the bedrock of any serious valuation. You're basically forecasting all the cash a company is ever going to generate, and then you pull it all back to the day's dollars to figure out what it's worth. It's detailed, it's rigorous, and yeah, it can get pretty complicated.
And this is the key. A multiple isn't some alternative to a DCF. It's a DCF in disguise. It's a shorthand for it. That simple PE ratio you see, it's just a compressed version of a full-blown DCF model. All those complex ideas about growth and risk and cash flow, they're all baked right into that one little number. It's not different math. It's just the final answer without showing you any of the work.
So, if a multiple is really just code for a DCF, what are the most important parts of that code? I mean, we're all obsessed with growth, right? But that's only half the story. The real engine of value is driven by two very specific forces.
The first, and maybe the most important, is something called return on invested capital, or ROIC. Basically, it's a measure of how good a company is at turning money into more money. And here's the thing. A company only creates real value when that ROIC is higher than its cost of capital, what investors demand for their money. See, growth is awesome, but profitable growth, that's the whole game.
So, let me ask you something. Take a look at these two companies. You've got company A growing at a pretty fast clip, 7%. But its returns are, well, they're mediocre. Then you have company B. It's growing a little slower, sure, but look at that return, a whopping 18% ROIC. Now, which one do you think gets the higher valuation from the market?
Well, the answer might surprise you. It's not even close. Company B, with its incredible returns, gets a multiple that's almost 4 times higher than the faster-growing Company A. This shows you that the market, when it's thinking straight, doesn't just pay up for growth. It pays for high-quality, profitable growth.
And this is the big takeaway right here. When you see a company trading at a really high multiple, the market isn't just betting that it's going to get bigger. The market is betting that it can keep up an elite level of profitability, that it has a strong competitive advantage for a very, very long time. That is the real story that's hidden in the price.
But what happens when the market isn't thinking straight? So far, we've been talking about math and fundamentals. But there's this other force, this invisible force that can come in and completely distort the numbers. It can hijack the entire story. And that force is investor sentiment. The collective mood of the market. It's that wave of pure optimism or pessimism that's not really based on the facts, but on emotion. It's when we shift from spreadsheets to stories, from rational analysis to, well, animal spirits.
And this mood, it has a direct mechanical impact on valuation. When the market is terrified, investors demand a higher return for taking on risk. That higher required return, the WACC, mathematically forces the multiple down. But when there's extreme greed, the perception of risk just evaporates. Investors settle for lower returns, which sends the multiple soaring. It's like a psychological fever chart for the entire market.
And during times of total euphoria, this effect gets supercharged. Greed creates what you could call a dual distortion. First, overconfident investors start plugging in these wildly unrealistic growth forecasts. That juices up the numerator in the value equation. At the exact same time, they basically ignore risk, which pushes down the discount rate, the denominator. So you're inflating the top number and shrinking the bottom one at the same time. The result isn't just a little bump, it's an exponential explosion in the valuation.
And look, this isn't just some vague feeling. These moods are driven by well-known cognitive biases. You've got anchoring, which makes us get stuck on a past price, even if it's totally irrelevant now. You have herding, which is just us following the crowd because, hey, they must know something, right? And then there's overconfidence, which convinces us that this time is different, that the good times will last forever. Every single one of these biases systematically poisons the inputs of a rational valuation model.
Okay, so this brings us to the final, really critical question. If a valuation multiple is part hard math and part human psychology, what are we actually looking at when we see a stock's price? How do you read the market's mind? You know, this gets at a huge philosophical divide in the world of investing. On one hand, you have the pure DCF approach. This assumes the market makes mistakes, and your job as an analyst is to figure out what a company is truly worth, its intrinsic value. But using multiples, well, that assumes something totally different. It basically assumes the market is right on average. So your goal isn't to find some absolute truth, but to find value relative to what everyone else is paying. And that's exactly why multiples are so plugged into the market's mood. They're designed to reflect it.
And we have seen exactly where this can lead. I mean, think about the peak of the dot-com bubble in 1999. The PE ratio for the entire S&P 500 hit 33x. Now, that wasn't because every company in America suddenly became fundamentally more valuable. No way. It was a historic high pumped up by pure collective euphoria where the story of a new economy completely drowned out the math of sustainable profits.
So the most important thing to remember is this. You have to reframe how you see these numbers. A valuation multiple. It is not a crystal ball. It doesn't predict the future. It's more like an MRI scan of the present moment. It's a diagnostic tool that shows you the exact set of expectations, the rational ones and the crazy ones, that are already baked into a stock's price right now.
And that leaves us with one last question for you to think about. The next time you look at a stock price, or the market as a whole, ask yourself, what are you really seeing? Are you looking at a carefully calculated measure of intrinsic value? Or are you just staring at a reflection of the crowd? A beautiful, mesmerizing, and sometimes incredibly dangerous story that we are all telling ourselves.